Stay on. Let's get in Pankaj Murarka, CIO of Renaissance Investment Managers, joins us right now on the show. Pankaj, it just seemed that there is a bit of a pullback from the 23,500 levels, which was a bit of a key level, and we getting sold into the strength again. Is this a market which is a sell-on rise until the earnings situation improves? How would you characterize it?
Good afternoon, Neeraj. I think, Neeraj, we are in a correction in a broader bull market. So I think the broader bull market remains very much intact. Yes, the fact is that we had a weak earnings season this quarter, where earnings have been weak, and there have been disappointments in earnings in significant part of the corporate sector, and which probably to some extent is reflecting probably a cyclical slowdown in the economy. Having said that, I still think that from a slightly more medium term, because I think about markets from a one-year perspective, I still think the India story and the overall outlook remains intact. I think now that we've had this correction, markets need to spend some time. So I think there'll be near-term volatility in the market in terms of moves. But I think these are not bad levels for investors taking a one-year view to probably start investing gradually if they have cash over the next few weeks or next few months. And I think probably once market settles down around these levels, it will get more stock and sector specific from here on.
Pankaj, the feeling that amongst most people is that now the multiples are a bit deceptive, simply because if the earnings numbers for Q3 as well do not improve, then you might not be actually trading very close to long-term averages. You might still be further away from long-term averages. And for a market which is not showing that kind of growth, why should it trade at a significant premium to long-term averages? How do you think about it? Do you think that's a good argument, and therefore could this correction in an ongoing bull market take us closer to 23, 22 or whatever level? I'm not asking you to predict a level, but you get the question that I'm trying to ask you.
Sure, Neeraj, sure. Market meaning I don't know where markets will go in the next, let's say 4 weeks or 6 weeks. Markets can correct by 3% or 5% at the index level from here on. But on your first question on the longer term valuation argument, a few quarters of slowdown does not change India's inherent structural high growth, earnings growth and high growth economy. The structural outlook for India, that remains very much in place, that India is the fastest growing economy, and India is also the fastest earnings growth in the region and globally as well. When we talk about long-term multiples, then they're derived basis long-term growth outlook. So I don't think so that long-term growth outlook has changed. Yes, but we have to accept that we are in the middle of a cyclical slowdown. And that slowdown is partly also because of the fact that the government did underspend in the first half of this year, because the first quarter was an election quarter. So everything had slowed down considerably. And once the government got into the office, it took them a while to settle down and get going, kind of a thing. So we've clearly seen in numbers that government has significantly underspent in the first half of this year. I think the government spending will come back in second half, and that should help our growth. So I don't think so growth has, meaning there is a moderate slowdown, but it's not a case that growth has collapsed completely or very sharply in that sense. And these kind of cyclical slowdown can and do happen in economy from time to time. So I don't think so that overall argument of valuation derating for India will play out or that holds. That's not my view. Having said that, we are in the middle of a correction in a broader bull market. Now, where it settles down, I exactly don't know, but it could be around these levels or another 5% lower. But all I know is investors having a medium-term to longer-term view should use this correction to their advantage and probably use it as an opportunity to invest and build their long-term portfolios.
Okay. Pankaj, one last question really. Won't take more time, but we're going to be talking to a sell-side analyst on tech, because that sector is seeing a pullback. Now, is this a sector that's run up quite a bit already, and therefore a bit of a pullback may not be necessarily looked down upon because a lot of things are correcting, or are there some other factors hitting IT?
Again, just to express my views on the sector, I think this is one of the sector which will lead Indian markets over the next 12 months or 18 months. So I think tech will lead the rally in markets or lead this bull market. As you said, the pullback that we're seeing today, probably I think it's a spillover effect of a weaker Nasdaq last evening, and also given the fact that the sector has done well. Stocks in the sector, even if you look at large cap names, they're up about 20% in the last 2 months or 8 or 10 weeks in an environment where the market is actually corrected. So while markets are down, most of the tech stocks are near, the large caps are near or have exceeded their all-time high. So the sector is an outlier sector. It's already shown that in the last 3 months. And I think pullback is just a reaction to that. But I think I'm of the firm opinion that this correction should be bought into the tech sector, because it's one sector which will actually lead the market next year in 2025.
Sorry, is that on the back of earnings growth, Pankaj? I mean, you reckon earnings growth will come roaring back, or is it actually it can't be valuation multiple adjustment, because valuations are almost in line with long-term averages, right? So it has to be earnings led.
Yeah, absolutely, Neeraj. I think there's a clear trend that's visible where discretionary spends globally and in primarily in US have been held back for almost now 2 years. Now that US is already into a rate cut cycle and the elections are out of the window, I think discretionary spends will come back. This has been the feedback or commentary from most of the, like, if you listen to the commentaries of the Fortune 500 companies or top IT spenders globally, they've been making similar comments, and I think some of the early trends are visible as well. So I think globally, IT will see a cyclical uplift, or a cyclical IT spends will go up cyclically, starting from which was slow, will start rising next year onwards, and that should drive higher growth for companies. I think probably in the first half it will be more driven by order intakes, and for that to translate into higher revenue and earnings growth probably will be more a second half phenomena, second half CY25 phenomena. But markets are smart enough to draw the trend or draw inferences from trends that they see, and stocks will clearly move ahead of final actually higher earnings growth being shown or delivered by companies, and which is where in that context I see that the next 2 or 3 years earnings growth for tech sector will be probably much better than what we've seen in the last 2 years.